This is Terrence Andre Banks with Information Age Financial Solutions, coming to you with technology and the economy. And came across this article from Market Watch. As always, I'm going to put a link inside the description. Brace yourself for the coming tech and debt wrecks. And with the number of IPOs being said, especially in the tech market, it reminds me of the 2000, if you remember the dot-com bomb in 2000, if you're old enough to remember that. And a lot of this has the same kind of flavor. I really like the title, as always, titles usually which draws me in. Brace yourself for the coming tech and debt wrecks. Today's IPOs, high yield debt and other securities are once again leading investors to disaster. Dive right in. George Bush once famously mangled the old saying, "Fool me once, shame on you. Fool me twice, shame on me." While it's embarrassing watching a video of him try to get out those words, it's going to be even more embarrassing for investors in the coming years when they realize they've been fooled twice. In both equity and debt markets, investors are buying securities that have identical characteristics to the disasters of the recent past. Whether it's initial public offerings, tech shares, housing debt, high yield debt, or sovereign debt, previous booms and busts give us a very clear guide of what will eventually end badly. Tech Wreck 2.0. One of the most convenient ways to gauge the bullishness of equity investors is to assess the quality and quantity of IPOs. IPO volumes tend to rise through the cycle, peaking when equity indexes are near their peaks. This makes sense, as those who own and manage business are generally well placed to identify when the market will pay them a favorable price for their business. This year has been so far a boom year for IPOs in the United States. While it's likely to be one of the best years since the record volumes of 1999 and 2000, when private capital raises are included, the recent boom is even bigger, with venture capital investments in 2008 smashing the record from 2000. Right there, when you see things smashing the record from 2000, you just better hold yourself, because usually a crash is coming soon. A good indicator of IPO quality is the percentage of new issues that are unprofitable. This topped 80% in 2000 at the height of the tech bubble, but this level was surpassed in 2018. Here we go again. Buying business that lose money indicates investors are preferring hope over experience. The IPOs of Uber, negative 18%, and Lyft, negative 2.19%. This must be from a recent market drops. This year has been both high-profile doozies to sum up the mood. Lyft went first, pricing at $72 per share, and is now tracing around $57. Its larger competitor Uber, priced at $45 per share, is now sitting below $41. Both companies have a long history of using capital raising to cover their losses, with no plans to become profit-making companies anytime soon. Roger Montgomery's pre-IPO analyst of Uber is well worth a read. Maybe. He likened it to a hot potato as backers were desperate to palm off to others. Harris Cooperman shares the sentiment. He posited those Uber IPOs were so big it might have soaked up most of the remaining speculative capital that punts on these sorts of ventures. Maybe worth your time to take a look at these two different articles here. Two potential future IPOs that look like twins of tech wreck disasters are Chewy.com and WeWork.com. Chewy.com is an online pet company supply that lost $268 million in 2018 on $3.5 billion of sales. It looks an awful lot like Pets.com, the poster child of the tech wreck that managed to go from IPO to bankruptcy in a mere 10 months in 2000. WeWork is an office subleasing business that lost $1.9 billion on $1.8 billion of revenue in 2018. It looks a lot like the tech wreck office space firm Regus, which filed for bankruptcy in 2003. One of the hallmarks of the tech wreck was dodging financial information and dubious measures of success. Technology companies are often pioneers, whether that be in software and services to provide or their ability to come up with distracting metrics. Some may remember the obsession with eyeballs rather than earnings back in the tech boom days. That sounds an awful lot like the monthly user counts that some investors are religiously monitoring today. Some of today's tech giants, notably Google and Facebook, have done a great job of turning their huge number of users into advertising revenue streams, leading some to assume that all companies with large user bases would inevitably be profitable. Forgetting that this assumptions need to have a near monopoly on a service that competitors can't easily replicate. Well said. See, Google and Facebook have that particular monopoly. The likelihood of Uber and Lyft turning out the same way as Google is extremely low, as the proliferation of alternative taxi service shows that consumers can quickly shift to another service that offers a better deal. So true. The inability to turn a profit when scale efficiencies are already substantial is another warning sign that shareholders are likely to be subsiding users for quite a while yet. In order to offer a fig leaf of credibility to their current valuations, many tech companies are creating bizarre financial terms. My favorite is community adjusted EBITDA for WeWork, which includes taxes, stock grants, marketing, and administrative costs. Tesla has long been called out for accounting shenanigans, with the regular turnover of its most senior accounting and financial officers another warning sign. Tesla's attempt at disguising its high level of cash burn recently came unstuck. The announcement this month that it will run out of cash in 10 months without radical change has seen the share price sink to almost half the level it was 6 months ago. It's only taken 20 years, but the hallmarks of excess in the tech wreck are back in play again. Now we're on to the debt wreck 2.0. The low point of 2008 financial crisis was just over a decade, but lessons that should have been learned have already been forgotten. The debacle that was U.S. subprime mortgages has come back to life, no doubt. In a similar way, the U.S. mortgage giants Fannie Mae and Freddie Mac have been cutting back on the down payments and loosening restrictions on the minimum income a borrower needs to service a loan. Lending quality in FHA's loans favored by first-time home buyers is particularly poor. This time around will be U.S. taxpayers picking up the tab through the government ownership and insurance of the mortgage aggregators. It's not just the U.S. where dubious mortgages are proliferating. Canada, Spain, several Northern Europe countries, and Australia have all been called out for excessively easy housing credit. Global high-yield debt markets seem determined to go beyond the stupidity seen in 2006 and 2007. The collapse in covenants, which function as an early warning sign for lenders, is a flashing red light. The lenders are desperate to push money out the door on almost any terms. In the lead up to the financial crisis, covenant-light leveraged loans were less than 30% of the total leveraged loans. Borrowers that were given covenant-light loans typically had B+ or higher ratings, having some level of inbuilt cushion. Today, only the worst of the worst borrowers contain a covenant-light loan. Holders of covenant-light loans should expect a slew of their borrowers to slowly bleed to death, with the lack of covenants having cut off the ability to take early action when the borrower still has some equity value. It's a similar story of the sovereign debt as the European debt crisis is likely to re-emerge in the coming years. Italy's economy is showing the same signs that Greece did before the ongoing debt crisis, but Italy is almost 10 times bigger. The doom loop of bank failures leading to government failures and vice versa hasn't been fixed. I kind of read that quickly. Increase the risk of systemic and cascading failures. Deutsche Bank share price hitting record lows shows this remains an enormous risk, but there are dozens of small and medium-sized banks in Italy and Spain that have and will continue to call upon their governments for additional bailouts. In the U.S., a wide swath of state and municipal governments continue to run up their debts, as well as accruing pension and health care obligations. Well said, states such as Illinois can add population decline to their list of issues, which reinforces the downward cycle of the smaller remaining population needs to regularly increase taxes to cover the increasing interest and pension obligations. I talk a lot about pensioners in this channel because I believe, again, this is one of the hugest crises in our lifetime. The defaults of Detroit 2013 and Puerto Rico 2016 show what lies ahead for bondholders. Heavy debt haircuts will be required to allow these jurisdictions to right their financial position. Emerging and frontier markets are now showing signs of kicking another cycle of defaults and restructurings. Last year, seen Argentina, Pakistan, and Turkey go from having easy access to debt markets to now needing assistance to meet their oncoming debt maturities. A slew of frontier economies, including Iraq and Tajikistan, have used the loose lending of recent years to issue debt despite having obvious challenges in meeting future repayments. Conclusion. It is often said that those who do not remember the past are doomed to repeat it. The investment decisions made by some in recent years bear the hallmarks of speculative investments made before the tech wreck and the financial crisis. With the recent pullback of several high-profile tech shares and bank shares and the surging yields of a handful of emerging market sovereigns, we might be witnessing the beginning of a necessary and inevitable process taking out the investment trash. Kind of a lengthy article. He's got some two other articles here that may be worth your time and attention. I tell you, we live in history repeats itself, and that's why I love reading this article. Gave a lot, chock full of information. Take a look at them, put a link inside the description. If this video has been any value to you, please subscribe, leave some comments. And to my next video, I'm out.